This is InvestTalk, independent thinking, shared success.
Hi, I work for a division owned by Leggett Platt, LEG. I'm wondering what you're thinking about their rising stock price recently. It looks like a couple of weeks ago they were up and then it took a dip. Does this signal support? My name is Ben out of California. Thank you.
All right, Ben. So Leggett Platt, ticker LEG, is a diversified manufacturer. They supply engineering components across consumer durables, furniture, and the automotive sector. Bedding products makes up about 40% of their business. Furniture and flooring makes up about 32% of their business. And then the rest is a mixture of specialty products. Now, if you look at this chart here, it shows the performance of Leggett Platt versus the S&P 500 going back to 2019. And you can see that they really didn't ever recover from a relative strength perspective from the pandemic. Started to go downward and then tracking, and then there's this big divergence in 2021 that continues. And the big reason why is because revenue is really all over the place, but generally downward. In December of 2019, revenue was $4.7 billion. This upcoming year, it's projected to finish out at 4.15. They lost money in 2023. They lost money in 2024. They're projected to be positive again, but there's a lot of volatility here around earnings, around margins, and at the same time, let's take a look at their balance sheet. It is a $1.3 billion company, so the fact that it's a small cap is one of the reasons why it tends to be more volatile, and they have $2.1 billion in debt, so a balance sheet that doesn't look very strong either. And even with the recent run-up, up 41.7% in the past 3 months, right? Because of some potential operating improvements that we've seen over the past couple months. But regardless of that, earnings really hasn't shown much positivity beyond estimates. Q1 2025, revenue $1.02 billion, down 6.8% year over year. The profit trend isn't great, and neither is the trend in cash flow. And so that's why, as you've seen the stock creep up, you see short interest creep up as well. About 7% short interest out there. Decent amount of shorts, not a crazy amount of shorts. But either way, I think the big two concerns here for me are balance sheet and profitability, both of which don't look very strong. And that's why it's trading near its low over the past 5 years, well below its average of forward-looking price to earnings, the average being 14.4, the current being 8.7. The other part of it as well, which I think is specific to you, is you don't want to get too invested in the company in which you work, because then your income and your assets are tied to the same thing. That's too high a correlation here. So this is a good example of why you probably don't want to be too heavily invested in the stock of the company for which you work. Either way, they have a lot of problems. Past 3 months, things have slightly started to get better, but still not at a point in which I would want to allocate to this name. That's Leggett Platt, ticker LEG. Alrighty, looks like we got our first live call from Grace, who's listening on AM 1220, who has a question about MicroStrategies. You own it, or are you looking to buy it?
Hi, thanks for taking my call. I don't own it. I'm kind of curious what you say about it, because I know you guys don't like any stock that does not make money, but maybe with exceptions. So what do you take on that? Would you own it? And if you do, what the price range you would answer?
Okay, so MicroStrategies is the company that is run by Michael Saylor, and it essentially just issues debt and equity to buy Bitcoin. It holds 200,000 Bitcoin, making its stock performance pretty highly correlated towards the price of Bitcoin itself. And so it issues the debt, convertible notes, loans to fund those Bitcoin purchases, which increases the financial risk associated with MicroStrategies. They also have different tranches of ownership that pay various dividends that Michael Saylor himself said, well, at some point we may stop paying dividends just because. And so what this company is it's not just a company that doesn't make money, right? Sometimes people invest in companies that don't make money, that are pre-revenue, pre-profit. This is a different situation here. This is a financial engineering. And so what you end up doing is you are actually paying a premium above the price of Bitcoin just to own something that is supposed to be correlated to Bitcoin, because the thinking is the premium is associated with the financial engineering to buy additional Bitcoin. It is predicated upon the demand for shares continuing to be moving higher and higher. In a way, older shareholders are only rewarded when newer shareholders purchase into it, giving them more capital to go out and buy more Bitcoin. There's also a lot of regulatory issues right around crypto. Now, certainly those are starting to develop in a way that is more beneficial to the industry than it was during the Biden administration. So the regulatory side of it isn't as risky as well. But, the risk profile using that debt to buy Bitcoin is essentially a levered bet on Bitcoin plus the premium you have to pay. And so, my thinking behind it is if you want to be correlated to Bitcoin, then just buy Bitcoin. Don't buy this financially engineered product where shareholders constantly get diluted, debt constantly gets issued, and the leverage itself, should we have a down cycle that we haven't had in a long time. Remember, Bitcoin has never really been in existence during an actual recession, and that's when the leverage can come back to bite you. So the core of it is, yes, it doesn't make money. That's not my problem with this company. If you want to own Bitcoin, if you want exposure to Bitcoin, just buy Bitcoin. That is MicroStrategy's ticker MSTR. Looks like we got a live call. Elliot from Mountain View, who's listening on AM 1220. Looks like you are going to ask about Chimera Investment Corporation. Do you own it, or are you looking to buy it?
It's a stock called ZIM, ZIM.
ZIM. We heard CIM. Okay, let's pull that one up instead.
Sorry about that.
Oh, no, it's not a problem. I'm sure you said it correctly. And sometimes, talking on the phone makes it a little difficult to understand letters. But I'm glad we got the right one here. And we're looking at ZIM, which is ZIM Integrated Shipping Services. It is a shipping and logistics company. It is an Israeli company. It's got a market cap of about $1.9 billion. And its revenue is really kind of all over the place. It's very volatile, as the shipping industry tends to be, right? From $3.3 billion in revenue in 2019, projected to be about $7 billion this year. Now, there's a lot to dive into this company, and certainly when we get back, we'll talk about it more and take a look at if it makes sense for Elliot or if it makes sense for any of you as well. Now, before the break, Elliot called in about ZIM, ZIM Integrated Shipping Services. We mentioned it's a $1.9 billion market cap company out of Israel that trades and is listed in the United States. It's got quite a bit of debt, $5.8 billion in debt. Now, its dividend yield right now, is that right? Sitting at about 45.7%, which is never a good sign. When there's a dividend yield that high, that's typically because the price has fallen pretty significantly, down 22.08% year to date. And that dividend yield is all over the darn place going back the past 4 years. 157% one year, 5% the other year. Now, 2024 was a decent year for this company. You see that revenue growth from 2019 to 2022 was explosive coming out of the pandemic, and then really poor in 2023, dropping from $12 billion to $5 billion. They lost money in a big way. Net margin was negative 52.2%. And there's been quite the turnaround, right? They had a huge financial turnaround, reversed to large losses with robust revenue growth from $5.1 billion to $8.4 billion. But now they're dipping again. Their net margin's falling from 25 down to 5.3. And the reason why is because, they're in an industry that is incredibly volatile. Shipping rates are not looking great right now. Shipping volumes are not looking great right now. And so for a company that is currently $5.8 billion in debt with 20% short interest out there, yes, this is a name that can squeeze, but the market's also signaling that this is a name that is very, very risky, because you have the company's specific leverage and then you have the volatility of the industry as a whole. And so certainly, I don't think this is a good medium or long-term hold at the moment. If you wanted to get into the shipping industry, I would look for something with far less leverage. and an ability, therefore, to ease themselves in times when the cycle is just not in their favor. That is ZIM Integrated Shipping Services, ZIM. All right, let's keep things moving and head back to the Anytime Listener Line voice bank and tackle this question.
Hey, Luke and Justin. This is Jake from the Bay Area. I'm in the middle of doing some rebalancing, and I'm looking to get a little bit more cash on the sidelines. I was just wondering, what percentage of my portfolio should I hold in cash? And what areas of the market do you feel like are undervalued currently? It does seem like most of the market is overvalued. Doesn't seem like there's a lot of deals out there right now. Trying to get your thoughts on where those undervalued sectors might be. All right, thank you.
It's a great question. So oftentimes, right, we move into a situation where a lot of our investments have done well, hopefully. We want to exit some of those positions, take some gains, and we're left with cash that either we reinvest immediately or leave on the sidelines. Now, to answer the first part of your question, how much cash is the right amount? There is no right amount. That's incredibly person specific. What are you using this money for? How old are you? How much risk are you willing to take on? For a lot of people, 4.5% sounds pretty juicy. 4.2% sounds pretty juicy. And so they're willing to hold on more cash, especially at a time they think the market is overvalued. For other people, well, they have long investment horizons and they don't want to hold on to as much cash. But if you're trying to strategically re-enter the market, having your cash in a money market fund or a short-term treasury fund can certainly be a good way to go in the interim. Now, in terms of sectors, right? Because one thing that we've seen is a huge run-up in the top line indices, but when you dive in, there is some pretty wide dispersion of performance. A handful of names have really driven the market higher over the past couple years. And so there are some sectors that are undervalued relative to what we see in the index overall. Healthcare is one of them, trading at 16 to 18% or 16 to 18 times rather, forward-looking earnings well below the S&P, which is above 22 at this point, making it, one of the cheapest it has been relative to the S&P in quite some time. You also have energy stocks that aren't doing particularly well. Why? Well, we just went over oil pricing. And so, yes, uranium's doing well. Natural gas is having some issues because it's supposedly supposed to be a particularly warm winter. Demand is down, and so given that, if you're looking for a long-term allocation to energy, now can be a pretty solid time to do it. Forward-looking valuations and financials are looking pretty decent right now, especially if you're looking for income and yield. And so just because, we're reaching record high, and the S&P itself is very expensive on a forward-looking multiple, and the Buffett indicator is through the gosh darn roof, doesn't necessarily mean there aren't opportunities out there. And so diving deep in, understanding what is driving the market as a whole can help you find these sectors where there are some pretty good opportunities. Thanks for the call. Let's talk tariffs. $55 billion in new tariffs have been collected in 2025, pushing U.S. tariff levels to multi-decade highs. And so who's paying them? Well, it's not the country on which they're imposed. That's not how tariffs work. And thus far, it hasn't really been consumers. Thus far, U.S. businesses are absorbing most of the burden, pretty reluctant to pass on those costs due to competitive pressures and uncertainty about what the level is actually going to be tomorrow, the next day, next month, let alone next year. Only 20% of the costs are being offset by foreign suppliers right now. And it's not because foreign suppliers are paying the tariffs themselves. They're saying to those businesses, okay, we're going to give you temporary discounts such that the cost you're paying to import is the same. So they're taking a loss and they add what they're selling it for plus the tariff, and the price is the same for the businesses right now. Now, that's not sustainable, but given that we don't know if this is a short-term thing or a long-term thing, some of the importers are willing to try and work things out for businesses. But even in spite of that, inflation is creeping up on tariff goods. June CPI rose 2.7% year over year from 2.4 in May, especially in select areas: furniture, toys, clothing. Corporate profits, which I already mentioned earlier in the week, mentioned today. You know, you look at some of these car makers, corporate profits are taking a hit. GM paid $1 billion in tariffs in Q2. Stellantis lost $350 million. Nike expects $1 billion profit reduction this fiscal year. And you can say, okay, better them than me, but as investors, that trickles down to us. If companies are having to pay more, that means profits are less. That means if you think the market's overvalued now, wait until you find out how overvalued it can possibly be. Companies are trying to delay price hikes. They're relying on cost cutting, supplier changes, inventory stockpiling, but they can't do it forever. Increases are going to come. Retail giants like Walmart are taking a more surgical approach. Bananas now cost about 10% more than they did before tariffs. Barbecue pit inventories have been trimmed. They're taking a look at certain products and saying, okay, we can charge more here, we can charge more there. This is the highest area at which our costs have increased. But here's the thing. Not everyone can do that. Not everybody's Nike. Not everyone's GM. Not everybody can shrug off $1 billion lost to tariffs. Not everybody can lobby the White House to get a deal on what they're trying to import. Small businesses are who I'm talking about. Far more vulnerable. Your niche retailers who are forced to raise prices or cut product lines to survive. Your local businesses, your local florists. The effective average US tariff rate is now 17%. We love to look at key benchmark numbers from way back when, so let's look a year ago. The number was 2.3%. Now there is some potential clarity from these deals that we've gotten from Japan, is a big trading partner of ours. Some of the other ones don't really matter as much, right? We're not importing much from some of the countries that have reached a deal. The ones that really matter are, well, look to the north, look to the south. We already may see the USMCA, which Trump negotiated in term one, be renegotiated in term two. Japan certainly matters. The European Union certainly matters. And the big one's China. The reality is tariff fatigue is setting in, not just because I don't want to talk about it anymore. It's something we as financial professionals think about and talk about all the time. I'm getting tired of it, but businesses are too. Companies are warning, listen, we've been absorbing this for now, but we can't absorb costs forever. And so unless something changes in the coming months, expect to see CPI increase, expect to see inflation increase. Expect to see a Fed who is more hampered with an ability to cut. That affects you everywhere, not just at the grocery store, but your mortgage, everything down the line. Alrighty, well, if you are a viewer and a listener, you may know that we are available on YouTube. And while you're over there, if you leave a question, we like to get to those as quickly as we possibly can. So let's at least try and start one right now. This question is on ticker ALE, which is Allete, spelled ALLETE, Energy. It says, can you give me an update? I'm a shareholder and was informed nearly a year ago that it was part of a merger and will be paid out at $67 per share. However, I have been unable, I believe is what it says, to find an actual date when it will happen. Let's take a look and see if we can find this date for you. Either way, let's get a high level here. So this is a company that engages in the provision of electric and natural gas utility services. Looks like in May of 2024, they agreed to be acquired for $67 a share. Shareholders approved the transaction in August, and regulatory approvals have come from Wisconsin authorities as well as FERC, but the Minnesota Public Utilities Commission, or MPUC, approval is still pending. And so the company itself is saying they expect the merger to be finished in mid-2025, though it is possible that they will see some continued delays beyond when they expected, which was August 5th. The reality is that sometimes these things take time. It's not just about the company boards approving. It's also about the regulatory authorities approving themselves. I will say this, here's a lesson here. If your stock is being bought for $67 a share, it should be essentially pegged to $67 a share. You see the price at $65.87, that's a little bit below $67. If you own a stock that is an all-cash merger and it's trading at the cash price, sell the stock. You're no longer holding an equity, you're holding cash. Get your money, put it elsewhere.
This is Art from Tucson, and I am calling about Zebra Technologies Corporation, ZBRA. Wondering where would be a good time to buy it, at what price. I'll listen on a podcast. Thanks for all you do for us.
Let's take a look at Zebra Technologies Corporation, that is ticker ZBRA. It designs, manufactures, and sells automatic identification and data capture products. It is a leader in enterprise data capture, and so it serves industries such as retail, healthcare, logistics, and manufacturing. They help frontline workers as well as just working through integrating systems across the board. Now, year to date, it's down about 13.08%, yet still up 36.33% in the past 3 months, meaning started the year in a pretty rough position. Revenue has slowed in terms of its growth, only about 2.3% on an annualized basis over the past 5 years, yet margins are kind of improving, right? They were about 8.1 and 6.4 in 2022 and 2023, projected to be 10.3% this year. Now, the past 3 months have been okay for for the performance of this stock, right? Up 36%, so pretty good. One of the reasons why is improving earnings. You had some pretty solid earnings reports in Q1 and Q2, which exceeded expectations. You had improved growth. You had restructuring, which cut operational expenses. That's one of the reasons why you're seeing these margins improve the way you are. Now, it is a fairly large company, right? $17 billion market cap, only about $2.2 billion in debt, with almost $1 billion in cash. So really not that much debt in terms of leverage on its balance sheet. Still, over the past 5 years, it's been kind of rough, right? Profitability is headed back in the right direction, but there was a consistent downward trend. Same with cash flow. And so all of this has moved it into a little bit more reasonable of a pricing range here, 21.1 times forward-looking earnings. This seems to be a company that is still recovering. It's recovering from cautious demand. Its business model, which is the hardware plus software, right? Integrated systems, integrated operations, works well, yet it's tied to each other in such a way that revenue can be pretty volatile. And that's what you see with revenue. It is rather volatile. You're not seeing huge swings, but percentage-wise, you are seeing some pretty decent swings here. I think the bottom line is the company has rebounded. It's rebounded pretty well, I would say. But, you know, anytime you're seeing a little bit of a turnaround, which you did start to see towards the fourth quarter of last year, you want to see some follow through here. Now, this is the warning I give oftentimes when we're approaching earnings. Historically speaking, your returns, expected return, tends to be negative when you're within 2 weeks of earnings. We are 2 weeks-ish, week and a half, away from earnings now. I would keep it on my watch list for now. It doesn't mean it's not going to beat. It doesn't mean the price isn't going to jump up. It just means it's a heightened time of volatility and a heightened time of risk. That is a ticker ZBRA, Zebra Technologies Corporation. Alrighty, I want to talk about the last thing quickly, because that is there's a new acronym in town. DORK, Krispy Kreme. It's for ticker DNUT, OPEN, RKT, and KSS. For meme stocks rallying on social media hype rather than fundamentals. You got that? You guessed it. Meme craze 2.0 is here. Retail traders are driving the action using Reddit and options to amplify these moves, just like what we saw with GameStop and AMC. Short sellers are getting squeezed here. Anytime you have massive rallies in stocks, people that are short the stock then have to cover because of the losses. It drives the price ever higher. And so what are these companies? Krispy Kreme, I already mentioned one of them. Open Door, Rocket, and Kohl's are all struggling with pretty questionable outlooks, yet they are soaring on this speculation. I'm not saying invest in these names. I think it is not a good idea to invest in names like this. Tell anybody who's still holding the bag on GameStop. Ask them what they think of the meme craze. But anytime you have froth in the market like this, it is time to step back and take notice. Understand that overhype and over speculation is typically when things start to turn. I'm Luke Guerrero. This completes another InvestTalk program. Justin and I thank you for listening and encourage you to tell your friends and family members about our free podcast downloads. And as always, if today's show made you think about your financial picture, your taxes, your investments, your retirement, your family, your workplace retirement program, and you want to talk about any of it, we are here to listen at KPP Financial. We do portfolio reviews for people like you all the time. Just head over to investtalk.com and click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.